Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to cash flow statement based on account activity. In other words, we're going to have an introduction into the account activity for a statement of cash flows after having taken a look at, in prior presentations, the other two main financial statements, balance sheet and income statement. Now moving on to the concepts related to the statement of cash flows. Get ready to take a stance with Corporate Finance. Here we are in OneNote. If you would like to follow along in OneNote, you don't have to, but if you have access to it and would like to, we are on the 230 section for the cash flow based on account activity under the practice problems section. Now, closing this back out, we're going to have our information. We're going to start with the concepts related to the cash flow statement. Now, remember, when you're thinking about the financial statements, the first two that come to mind should be the balance sheet and the income statement, where we stand as of a point in time, and the activity, how we have performed over the year, that being the balance sheet and income statement, respectively. However, the income statement in particular is showing us how we did over time on using a particular basis, that particular basis being an accrual basis. Now, the accrual basis is the best way to measure performance for many different things. However, it doesn't measure cash flow as well as a cash basis would. And we want to still know about cash flow because although a cash flow basis will distort other type of measurements for how well we did for the income statement, therefore we use the accrual basis, we still want to know a cash flow basis because the flowing of cash, of course, is an important characteristic. Therefore, we tack on then another statement, that statement being the statement of cash flows. Now, so we're going to introduce, just like we have before, some concepts related to the statement of cash flows, and then we'll build on that and then create a statement of cash flows so that we can get an understanding of what it is doing. Obviously, we are measuring here the cash flows, what's happening over time with relation to cash flow. So note that the cash flow statement is similar to the income statement in that it's measuring some type of performance, meaning it needs a beginning and an end. It's not as of a point in time where we need to know a time frame, a beginning and an end. This is what happened over the last month. This is what happened over the last year. These are the outflows and inflows of cash that happened during this time frame, as opposed to the balance sheet. When we think about cash on the balance sheet, we're thinking about how much we have as of one point in time. We're not thinking about how much we got or how much we gave in a time frame. That requires a time frame, a beginning and an end for us to do that. Here we are in OneNote. If you would like to follow along, and you're not required to follow along in OneNote, but if you have access and would like to, then we are in the 230 section for the cash flows based on account activities. That's under the Practice Problems tab. Closing this up, like with the balance sheet and the income statement, we're going to introduce some concepts related to the next financial statement we will be looking at, that being the statement of cash flows. Then we will go further and actually create the statement of cash flows, getting a better idea of it as we do so. Remember that these items will also be in Excel. We'll have Excel problems, so if you want to work through this in Excel, I highly recommend doing that. I highly recommend using these problems to help work on, your basic fundamental Excel skills as well. When you think about the financial statements, remember that the first two financial statements that should come to mind should be the income statement and balance sheet and income statement. Those are the first two you want to think about. The cash flow statement is going to be then tacked on to that, because the cash flow statement is a performance statement, which is rearranging some of the numbers to be on more of a cash flow basis, showing cash flows, inflows and outflows of cash, whereas balance sheet and income statement are on the accrual basis. So the reason you want to think about balance sheet and income statement first is, one, because the balance sheet and income statement basically are all the accounts that have activity in them are basically included somewhere on the balance sheet and income statement. So they're comprehensive. They are the entire chart of accounts basically that have activity will be reported in there. We're going to rearrange those numbers and rearrange how the accounting is done to show the cash flow basically on a cash flow statement. Therefore, you have to do the balance sheet and income statement first to do the cash flow statement. Also, balance sheet and income statement typically represent the major performance, meaning, if we had to just take the two statements that would best represent how the company did, we would typically use the balance sheet and the income statement, because the balance sheet shows where the company stands at a point in time as of the end of the time frame, and the income statement shows performance, how well the company did. However, that performance, how well the company did, is not on a cash flow basis. It doesn't show the cash flow because we're doing it on an accrual basis, which typically is better for most measurements that we want to have in terms of how we did for performance. But we also want to know the cash flows because we want to see if the cash flows are good, if we can pay our current obligations and whatnot. And therefore, we're going to tack on the cash flow statement. So we have the best of both worlds, right? We want to measure things on an accrual basis because cash flow can be distorted in order to distort, our reading of how good we did simply by changing the flow of the cash. Therefore, we can't have our performance statement, income statement using a cash flow basis because it's too easily distorted. We have to use an accrual basis. However, we still want to know the cash flow basis. Therefore, we have another cash flow statement, that being the statement of cash flows. Therefore, you want to think of the statement of cash flows as similar to the income statement, a timing statement. It's measuring something over time. Therefore, you have to have a beginning and an end. You got to say for the 12 months ended, for the year ended, for a 12-month time period, these were the inflows and the outflows. Or for the month ended, for that 31 or 30-day period, here are the inflows and the outflows, as opposed to cash on the balance sheet, which simply represents how much cash we have as of one point in time. So we're going to think about this similar to like an income statement. You want to think of this as activity statement telling us performance. What's the performance? Cash that went in and out during the time period. I'm going to scroll down to an example at the bottom of this thing first. This being an example statement of cash flow. We will create this in a future presentation. And we basically have three categories to the cash flow statement, that being operating activities, investing activities, and financing activities. So operating activities, investing activities, financing activities. So we want to group the flows of cash into these three activities. Now, the first one is going to be where most of the activity is, and it's going to be similar or paralleling what happened on the income statement. So what happened on the income statement, we're measuring operating activity, basically performance, but on an accrual basis. The cash flows from the operating activities then will be measuring this information on similar information, same information from a cash flow basis, more on a cash flow basis. Therefore, we can compare the bottom line of the income statement, net income, to the bottom line of the cash flow, which would be net cash flows from operating activities, which basically is net income on a cash flow statement, or you can think of it close to being basically net income if we were to have conducted the income statement using a cash basis as opposed to an accrual basis. However, there are some things that have cash flow that don't get reflected in the normal operations, and therefore they're things that wouldn't be reflected on the income statement but would be, balance sheet type of activities. So that would be including cash flows from investing activities, which may be things like us investing in large pieces of equipment, like buildings and cars and forklifts and whatnot. And those kind of transactions, even if paid cash would go out. We'd purchase the asset. Notice that would be a debit to or an increase of an asset, and then cash, the other asset, would be going down. No effect on the income statement. Therefore, it's going to be here in basically investing activities. Then we have cash flows from financing activities, which could include, again, cash flows that don't normally affect the normal operating activities, including taking out a loan, for example. If we took out a loan, then cash would go up, and the other side would be a payable. Nothing happens to the income statement until we have interest expense, which is the rent on the loan. So that would be a financing activity down here. We might pay off the principal of the loan, which would be financing. We could have dividends that we pay off, which again would affect equity and cash. No effect on the income statement. Therefore, there is a cash flow, but not really what we would include in operating activities. Therefore, cash flows that we consider to be operating activities will typically be up here. Cash flows from operations, if they kind of would be something we would think about being on the income statement on an accrual basis, then they would typically be up here on the cash flow statement. And then anything that would not would be down below. Also note there's two ways that we were going to do the cash flow statement. Up top, you could use a direct method or an indirect method. We will typically be focusing in on the indirect method because although it's not as easy or as intuitive for many people to read, because the direct method would basically be like taking the income statement and reformatting revenue and expense to be on a cash basis method, and therefore it's kind of more intuitive to think about the direct method. However, the indirect method gives us a reconciliation of net income on an accrual basis and basically net income or net cash flows from operating activities on a cash basis. And that reconciliation is nice and often required by some regulations, and therefore, even if you do a direct method, you still have to do the indirect method, and therefore, people typically learn the indirect method. So the indirect method's a little bit confusing here because the way we look at the indirect method is, although we're concentrated on change, kind of like balance sheet, kind of like income statement accounts activity over time, we actually do so by considering the balance sheet, the change in the balance sheet. So we'll actually, as we'll see in a future presentation, we'll take a look at the difference between the balance sheet accounts, beginning balance sheet accounts or the end of last year, and the ending balance sheet accounts, the end of the current period we are looking at. Take a look at the change in those accounts, and notice the change in those accounts represent activity in total. They represent where we stood before minus where we stand now, gives us basically a representation of kind of what the income statement shows, or at least in part. That's going to be the change of how we got from there to here. So we're actually going to back into kind of like the income statement numbers by taking the difference between the prior period and the current period. So we'll be looking at changes in the balance sheet and then trying to figure out where to allocate that change. What does that change due to? And that's how we'll construct the statement of cash flow. So that can be a little bit confusing, but again, will become more clear as we actually do the problem next time. Right now, what we want to do is we're going to look at components of the statement of cash flow and discuss whether or not they're going to be increasing or decreasing the cash flow. So for example, we have this item, which is an increase in accounts receivable. What does that mean? That means accounts receivable from last year to this year went up. People owe us more money now than they did at the end of last year. That results in a decrease in the cash flow statement. And we got to think about, well, why would that be? Two ways we could do that. One is we just kind of memorize the rules related to it. And two, we can mull over them to do that. So first, I would think about mulling over two accounts, one being the accounts receivable, one being the accounts payable, those being an asset and a liability account, and then think about the rule, then apply that rule to all other accounts. So let's think about that. We will first mull this over in terms of transactions for the accounts receivable, and then apply the same rule to other assets, and then the opposite will be the rule for basically the liabilities and payables. Okay, so we're going to go into some transactions. We don't do this as much, go into individual types of transactions with finance, but it's useful to do so in order to kind of analyze this cash flow statement and understand the indirect method. So what are the two transactions that result in AR, accounts receivable? Remember, we're talking here about either the accounts receivable goes up or down based on from last year compared to this year. People owe us either more money now as compared to last year, or they owe us less as compared to last year. Well, there's two transactions that usually affect accounts receivable. One, accounts receivable goes up when we make a sale. When we send out an invoice, that means AR goes up, and then sales go up, revenue goes up. So that means that revenue here is going up, net income is going up then, even though we didn't get any cash. So this is a non-cash transaction. This is what we would need to reverse that out because it's a non-cash transaction. And then down here, when does accounts receivable go down? It goes down when we get paid on account. We get paid, cash goes up, but the other side doesn't go to sales because we did the revenue in the past. We record the revenue last time, which could have been last period and not this period. So we might have recorded the revenue last period, but got the cash in this period. But on a cash basis, we should be recording the revenue at the point in time that we got the cash. So on a cash basis, when we got the cash, we should be increasing cash and increasing revenue. So over here, it could be that we are then not recording the sale in the current period when we should. So the question then, there's going to be transactions happening in the whole time period that are going to be similar. These two types of transactions are going to be happening all year long. But if this transaction happened more than this transaction, that would mean that we made more sales than we collected on sales. And that would mean that the sales account would be overstated. Net income would be overstated from a cash perspective because we would have recorded income for things that we have not yet received the cash. Therefore, if accounts receivable goes up, we've overstated the net income, so net income would go down. Therefore, it would be a decrease on the cash flow statement. If, on the other hand, the accounts receivable went down, that would mean that this transaction happened more than this transaction. So on total, we would have this transaction, meaning we got cash and the accounts receivable went down. But when we got the cash, we should have, on a cash basis, recorded the revenue at that point in time. So if accounts receivable then went down, we're going to have to increase the net income for the cash that we received, where we should have recorded the sale in the current time period. So that means that if accounts receivable goes down, we're going to be increasing the cash flow statement. So the general rule then is going to be this: if it's an asset and the asset increases, then we're going to decrease the cash flow statement. And if the asset decreases, then we're going to increase the cash flow statement. That's the general rule. And then liabilities will be the opposite. So liabilities, if liabilities increase, then we're going to increase the cash flow. If liabilities decrease, then we're going to decrease the cash flow. So once you've proven this to yourself, then you just kind of apply the general rule. But you want to understand it to some degree so you can analyze the cash flow statement. So let's just take a look at these. We've got an increase in accounts receivable. What's going to happen to the cash flow statement? Well, accounts receivable is an asset type of account, and if it goes up, the general rule is that we're going to decrease the cash flow statement. We're going to have to pull that amount out. That's the one we just thought about in terms of the net income, because the net income is overstated on an accrual basis when we go from accrual to a cash basis. Therefore, we're going to have to decrease the amount that's net income. Then we've got the increase in notes payable. So notes payable is a liability, and the other side isn't going to be on the operating section, but if notes payable in the balance sheet account increased, it's still a liability. So we're going to apply the opposite rule that we did for the accounts receivable. It's going to go basically the same way as what it says. So liabilities will basically do the same thing as the change, meaning if it went down or if it increased, we owe more money in the current time period. Then we do the same thing for the cash flow statement. We increase the cash flow statement. And then if we have depreciation expense, now this one's a little bit confusing because we'll see depreciation expense and it's an expense. And you're going to think, well, on an indirect method, we start at net income and we reverse the balance sheet accounts. Like, why do we have an expense? We're talking about changes in balance sheet accounts. Well, where does that expense come from? It is a change in a balance sheet account. It's a change in the contra account or accumulated depreciation. It represents us allocating the property, plants, and equipment out over to the time frame in which they're affected. And the depreciation expense is not a cash related item. We record depreciation expense and we credit or decrease the accumulated depreciation. So that means that it's an expense, and that means it decreased the net income, and there's no cash related to it. Therefore, on a cash basis, we need to increase the cash basis. Then we got an increase in investments. So increase in investments. These are going to be investments that we made. So we can think about investing in stocks and bonds or something like that. It may not be an operating activity here, but same rule. It's an asset type of account. So if there was an increase in it, then we would decrease the cash flow statement in alignment with the general rule. Decrease in accounts payable. Now this is a liability, so it's the opposite of the general rule for the assets. If there's a decrease in accounts payable, then we would decrease it for the cash flow statement. Accounts payable, the other side, would typically be an expense or inventory, and so it would typically be on the operating section, although they're not asking for that here. Then we have the decrease in the prepaid expenses. So prepaid expenses, what are those? Those are going to be asset type of accounts. Typically, like insurance is the most common example of a prepaid expense. So it's an asset type of account, and it decreased. Therefore, we're going to increase the cash flow statement in accordance with our general rule. Then we have the increase in inventory. What is inventory? It's going to be an assets type of account. So it's going to be on the assets section. If it went up, it's an asset and it went up. So within our general rule, that means we're going to decrease the cash flow statement. Then we have the dividend payment. So the dividend payment's a little bit different again, because it's not saying this isn't a change. They're not giving us a change here. They're telling us what the change is, right? And where does that change belong? Like, where is it in terms of the difference in where we stand last period to this period? It's in the difference in retained earnings. It's part of the difference in retained earnings. So this time they gave us part of the difference in retained earnings, which is going to be reported as, on the cash flow statement, but we think about it as a change or difference in part of the difference in retained earnings, as we'll see when we do the statement. And that then is going to be cash going out, therefore it's a decrease. So they told us the flow, we know it's a flow because it's dividends, money went out from the company, therefore decrease. And then we have an increase in the accrued expenses. What are accrued expenses? They're expenses that went up that we have not yet paid. They're liabilities. So it's a liability account. And if there's an increase in it, then we're going to do the opposite of what we do with the assets. We're going to do the same thing as the direction of the activity, which is an increase. Therefore, we're going to increase the cash flow.